Insurance. The definition of insurance is that insurance is financial protection against a possible loss that may or may not happen. Now, before we get into the types of insurance, we have to look at the risk and the risk management. Risk management. This is a planned approach to minimizing the risks to which the company is exposed. That might be the risk of burglary, the risk of theft, the risk of fire, the risk of accidents. So, steps in risk management. Identify all the risks that the business might experience, such as fire, negligence, accidents. What could cause the losses? What's the likelihood of the loss happening? Calculate the various methods of protecting the business and take out insurance on the risk. Now, how do we reduce risk? So, a change in location, particularly if the business or the household is prone to theft. Cease activities that could cause the losses. For example, if there's an activity in the factory that causes, say, spillages that could cause someone getting hurt, then stop that activity. Install security devices. Arrange regular inspections and security. Educate and train employees, particularly in the lifting of equipment, the lifting of goods and services, or goods rather. Maintain equipment in good condition and store valuable stock in different areas. And of course, that stock should be locked. Okay, now that could come up. Outline risk management and then outline strategies for reducing risk. That would be 15 marks. Now we're going to look at the principles of insurance. There are 7 main principles of insurance. Insurance is a contract made with an insurance company in return for a fee, and that fee is known as a premium. Premiums will take into account the size of the item and the value of the item. The insurance company will compensate the insured for any loss or damage suffered. That's the principle on how insurance works. Let's have a look at the first one. Insurable interest. The policyholder must benefit from the continued existence of the object and suffer from its loss. The loss must be financial. Now, it is not necessary to own the asset to have an insurable interest. For example, a tenant may have a legal liability to insure against damage under a lease agreement, for example, car insurance. Right? So, in other words, if you're leasing a car from a garage, you're renting the car from the garage. It is your responsibility to take out the insurance, not the garage. Emotional attachment is not enough to establish insurable interest. There must be a legal relationship. The second one, utmost good faith, or oberrima fidei. The insured must give truthful information and disclose all material facts on the proposal form. A material fact is a piece of information that helps the insurance company to assess the risk or premium. If a material fact is deliberately omitted or lied about, the contract can be declared void. Now, indemnity. This is very interesting because I want you to underline 2 areas here. The insurance company guarantees, underline guarantees, the person taking out the insurance to compensate against any loss. But the insured, and underline this, cannot make a profit from insurance. So the insurance company guarantees you cannot make a profit. You must state those 2. Compensation is only for the actual loss, usually the cost of replacement. Subrogation. This is the taking over by one party from another the right to take legal proceedings. After paying compensation, the insurance company is entitled to take over the property left. It can also take over the rights to sue any other party responsible for the damage. Contribution. If a person insures the property or items with different insurance companies, then each company will pay only a proportion of the claim. For example, if the value of the property is 150,000, insured with company A is 50,000 and insured with company B is 100,000. The damage is 21,000. What does each insurance company contribute? So, company A will pay 50,000 over 150,000 multiplied by the 21,000. Company B is the 100,000 over 150 multiplied by 21,000. That's 14,000. So the damage was 21,000. No profit is made, but the damage is covered. Number 6, average clause. This applies to a partial loss when you are underinsured. The insured will only be compensated for a proportional amount of the loss. For example, if you have a house valued at 200,000 and it is insured for 120,000 and the damage is 20,000, how much compensation will they receive? So the formula is the value of the insured over the value of the property multiplied by the loss. So 120,000 divided by 200 multiplied by 20,000, the compensation will be 12,000. Proximate cause. Now this is the last principle. An insurance company is not liable for any loss under an insurance contract unless the proximate or approximate cause of the event was the risk insured against. For example, theft is not covered under fire